Thank you, friends, for tuning in. I'm your host, none other than Mr. Spotter Fred. I'm happy to meet you once again for this lesson. Now, today's lesson, we are dealing with advanced financial reporting. And in this session, we want to talk about chapter 3 in our texts, in our study texts. But it can be taken as our chapter 2 if we reorganize the course content. But according to our texts, it's a chapter 3. And that is in respect to assets and liabilities. Remember, want to look at advanced financial reporting, right? That is, today we want to look at topic 3. And the topic 3 is about assets and liabilities. Assets and liabilities. What are these assets and liabilities? There are a good number of assets and liabilities. One, items you want to deal with here, one of them is the assets held for sale. Assets held for sale. And also, when you talk of assets held for sale, sometimes we may not forget to mention discontinued operations because they are all under the same standard, IFRS 5. You know, assets held for sale, they are all under the same standard. That's with the discontinued operations. Then we'll also want to deal with, apart from assets and liabilities, we have impairment. We have impairment of assets. Impairment of assets, that is IAS 36. IAS 36. We also want to deal with the exploration of minerals. That is IAS, it's not IAS, is IFRS 6. That is IFRS 6. We'll also want to deal with employment benefits. Employment benefits. That is IS 19. We'll also want to deal with the deferred taxes, accounting for taxes. That is IS 12. We'll also want to deal with the one more item. We have said assets for sale, impairment of assets, exploration of mineral resources, employment benefits, accounting for taxes. We have financial instruments. Financial instruments is this one will have the IS 32, IS 39, IFRS 7 and IFRS 9. So those are the elements we will want to look at in respect to assets and liabilities. Remember, as far as assets and liabilities for Section 6 Advanced Financial Reporting, that's what we'll be doing. But that does not mean that this is the only composition of assets and liabilities. We have many other items for assets and liabilities, like maybe leases. You know, we have leases, we have other items, but that one is not under advanced financial reporting, is in other levels. So this is what we are going to deal with. Now we'll start with the assets held for sale. Assets held for sale. The IFRS 5. Will not forget to mention that IFRS 5 deals not only with the held for sale items, but also discontinued operations. You can also say as an overview that IFRS 5 deals with the provisions of assets held for sale, and accounting for discontinued operations. Discontinued operations. That's what will, but we may not want to go into details of the discontinued operations. Now, assets held for sale, it comes or arises at some point where a firm will decide to classify, will decide to sell. In between there, they may have a decision of selling some non-current assets. Maybe they want to do away with the land. They want to do away with the building. So they will want to recognize it as they want to sell it. They may not sell it immediately because they may not have a buyer immediately. So they will recognize it in the books as held for sale. It had already, the decision had been made in order to sell that asset, but it has not been sold immediately and is likely to be sold in the next 12 months. So it will be reported as a current asset and it will be labeled as maybe it was land or it was building. It will be land and building held for sale. If it's an equipment, it will be equipment held for sale and it will be reported as a current asset. Now, those are just a preview of what we should do. Now, we need to introduce further the details of these elements as far as assets held for sale is concerned. Now, an asset held for sale, as we have said, is an non-current asset which has been put in a position of sale, which the directors or the decision makers have agreed and have decided to sell it in the near future. So they will not recognize it as an non-current asset anymore. Now, in respect to IFRS number 5, IFRS number 5, paragraph 5 gives the provisions when an asset is to be recognized as held for sale. These are the provisions. Now, one of the provision is management is committed to plan to sell. 2, the asset is available for immediate sale. 3, an active program to locate a buyer is initiated. 4, the sale is highly probable within 12 months of classification as held for sale, subject to limited exceptions. 5, the asset is being actively marketed for sale at a sales price reasonable in relation to its fair value. 7, actions required to complete the plan indicate that it's unlikely that the plan will be significantly changed or withdrawn. Now, those are the main provisions. The assets need to be disposed of through sale. Therefore, operations that are expected to be wound down or abandoned will not meet the definition, but may be classified as discontinued operations. An entity that is committed to sell and involving loss of control of a subsidiary that qualifies for sale classification under IFRS 5 classified all of the assets and liabilities of that subsidiary as held for sale, even if the entity will retain an uncontrolling interest in its former subsidiary after the sale. Now, held for distribution to owners classification. In paragraph 5, subsection 12, it says this: the classification, presentation, and measurement requirements of IFRS 5 also apply to an non-current asset that is classified as held for sale or for distribution to owners. So the paragraph 12 gives the provisions of how to measure the assets held for sale. Paragraph 12, 15, 16 there, we are able to know how we should measure and recognize these assets held for sale. Now, according to those paragraphs, we should recognize or we should measure an asset held for sale at the lower of. It should be at the lower of the carrying amount or the fair value less cost to sell. Now, the carrying amount, remember friends, is simply the book value. The carrying amount is the net book value. The carrying amount is the depreciable cost, is the depreciable historical cost of an asset, where you take the cost of the asset, you subtract all the accumulated depreciation to the point when it was decided to be held for sale. So you take the cost, you subtract all the accumulated depreciation up to the point where it was reported, it was to be recognized as held for sale. Then you get the net book value. That's the carrying amount. Then you compare the carrying amount with the fair value less cost to sell. Friends, when you say fair value less cost to sell, is simply the market price, the amount that you're likely to sell this asset at the market price. You know, the fair value is the price that the willing buyer, willing seller is ready to exchange at an arm's length transaction. So simply the market price of that particular item will less all the expenses that we are likely to incur in the process or in order to sell that particular asset. So you take the fair value of the market price, you subtract all the expenses that you're likely to incur, then the net realizable value. That's what we call fair value less cost to sell. That's the net realizable value. So we compare the lower, just the way we deal with IS number 2, inventory, accounting for inventory. We recognize the lower of cost and the carrying amount. This, the net realizable value, sorry. Then this is the same story, that when we talk of assets held for sale, we now not compare costs and net realizable value as inventory, but we compare the carrying amount and the fair value less cost to sell. We compare the carrying amount and the net realizable value, the lower of. If the net realizable value is lower than the carrying amount, then recognize the net realizable value. If the carrying amount is lower than the net realizable value, then recognize the carrying amount. That's what we are trying to simply say. Fine. When it comes to the group aspect, a disposal group is a group of assets possibly with some associated liabilities, which an entity tends to dispose of in a single transaction. The measurement basis required for non-current assets classified as held for sale is applied to the group as a whole, and any resulting impairment loss reduces the carrying amount of the non-current asset in the disposal group in order of allocation required by IS 36. Now friends, again, you need to remember about discontinued operations. I may not go into details about the discontinued operations. We have already simply said about assets held for sale. Assets held for sale, you need to recognize it as a current asset. You need to recognize it and measure it at lower of carrying amount and the fair value less cost to sell. But how about the discontinued operations? For the discontinued operations, we need to have the mind of consolidation in our mind, and we'll be doing it in our consolidation. One of the lessons, we have done consolidation and we have also done discontinued operations. When we come to discontinued operations, you need to recognize the profit from the discontinued operations. You also need to recognize the gain or loss on selling the shares or discontinuing that particular operations. Then the two figures will be added to recognize one single figure, which will be either a profit or a loss, and that will be reported in the consolidated financial statements. That's simply what we should do for the discontinued operations. Remember, we don't recognize any asset or liability of our discontinued operations in our statement of financial position. So that's simply what we have said about IFRS number 5, assets held for sale. And that will be the end of that topic and maybe that session. We'll want to start almost immediately the other session, and that will be dealing with the impairment of assets. So friends, remember we have talked about the assets held for sale, and basically what we have simply said, assets held for sale are those assets which the management had planned and made a decision, are really engaged in selling it. They are going around looking for a buyer, and they have decided to do away with the asset. This asset held for sale will be reported, will be initially recognized and measured at the lower of the fair value and less cost to sell and the carrying amount. Remember we have said the carrying amount is simply the net book value. The carrying amount is simply the, the book value of an asset. Then the fair value less cost to sell is simply the market price less all the expenses you are incurring in order to sell that particular asset. Then another item that is under IFRS 5 is the discontinued operations, which will be covered in consolidation. We'll talk of discontinued operations in consolidation. So that's not a big problem. We'll easily cover it when we get there. Now, assets held for sale will have an example. We'll have an example of assets held for sale. But before that, I need to remind you this, that measurement of assets held for sale, measurement of assets held for sale will be, and recognition, initial recognition, measurement and initial recognition. The lower of carrying amount and fair value less costs to sell. Now we'll want to, and this one, apart from that, you need to remember that the value selected for the asset will be reported under current assets. So let's look at an example. Let's look at an example to capital. Example, ABC Limited, or rather we say the management of ABC Limited is committed to a plan to sell a motor vehicle whose details are as follows. As at 30 June 2016, we have the original cost, which is 800,000, accumulated depreciation as at 30 June 2016, 200,000. The net book value as at 30 June 2016 is 600,000. During the current year, on 31st December 2016, when the decision to sell the asset was made, the market price of the motor vehicle was 350,000, and a commission of 2% on sales could be paid to the sales agent. The policy of depreciation is to depreciate at a rate of 10% on costs. The asset had not been sold as of 30 June 2017. Required, determine the amount of motor vehicle to be reported in the statement of financial position and discuss other accounting treatment for the year ended 30 June 2017. Now from the required, it means that our financial year begins on 1st July and ends on 30 June of the subsequent year. So our current financial year must have started on 1st July 2016 and ends on 30 June 2017. So the original cost at the beginning was 800,000. Accumulated depreciation as at 30 for the year which ended 30 June 2016 was 200,000. So the net book value at the end of the previous year, which ended at 30 June 2016 was 600,000. Then during the year, which means that during the year is on 31st December 2016, that's after that 1st December 2016, when the decision to sell the asset was made during the year, I think when we talk of 31st December 2016, is just after 6 months. After 6 months, when the decision to sell the asset was made, the market price of the motor vehicle was 350,000. That's the fair value. But we need to less the expenses we are likely to incur. Then there's a commission of 2% that need to be paid on the sale. So 2% on 350. So you're going to have 98% could be paid to the sales agent. The policy of the depreciation is that we need to recognize depreciation at 10% per annum on cost. That's okay. So that means we need to compute depreciation for the first 6 months, the depreciation for the first 6 months, so that we are able to determine the carrying amount at the reporting date. Then we have been told to determine the figure to be reported in the statement of financial position, which definitely will be the lower of. The lower of, and that figure will be reported as a current asset in the statement of financial position. So without wasting time, we are interested to know the amount to be reported, in the statement of financial position, in the statement of financial position, or financial position, or financial position. Items, we need to recognize this by taking the lower of A, the carrying amount as at 30th June 2017. What will be the carrying amount? Is simply we take the net book value of the previous year, which was 600,000. We subtract the depreciation expense for the 6 months, which will be 10% on the 800,000 for 6/12. Definitely that's the 80,000, then that's 40,000. So definitely these will be 560. Because 10% of 800,000 is that would be 80,000. Then 6/12 of that is 40,000. So 600 minus 40 is 560. Then B, the fair value less costs to sell. In other words, the net realizable value. What will be the net realizable value? The market price per share, the market price is 350,000. We subtract the 2% of the 350,000. So, or we just say 98%. 98% of the 350,000. So we'll take our calculator. So 98% by 350,000 is 343. So that's 343,000. So friends, as you can see, the lower of definitely the amount to be reported will be the 343,000. That's the amount we're going to report in our statement of financial position. But again, you need to know that there is a loss of value. If you compare the net book value that we reported and the fair value, there is a loss. So there is a loss on recognition. And the net book value was 600,000. So if you take the 600,000 minus the 343,000, so there is 257,000. So there is a loss. Apart from that loss, there is a depreciation that we are going to recognize for the current year. That depreciation must be reported in the books, and that's the 40,000. So don't forget that other figures to be reported in the statement of financial position. One, there is the depreciation expense. Depreciation expense for the 6 months. for the 6 months ending 30th, ending 31st, no 30th, 31st December 2016, which is simply 10% of the 800,000. Then for 6/12, which is definitely 40,000. Another item is the loss on recognition, loss on recognition, because the net book value as at 31st, not 31st, yeah, as at 31st December 2016 could definitely be the 600,000 minus the 40,000, which is the 560. Then we also have the fair value, less cost to sell is 343. So there is a loss need to be reported in the books. That is 560 minus 343, that is 217. That need to be recognized as a loss. Loss need to be recognized in the books. And that's what you need to remember. Then presentation, don't forget when it comes to the presentation, L for sale asset, should be presented separately, in the statement of financial position as a current asset. Now this is in respect to IFRS 5 paragraph 38. That is in respect to paragraph 38. Something else that you need to remember is about disclosure. So disclosure requirements. These are the disclosures that you are required to do for assets held for sale. These are the disclosures you are required to do for assets held for sale. One, that's according to IFRS. That's according to the IFRS 5 paragraph 41. So one, description of the non-current assets or disposal group. 2, description of facts and circumstances of sale and the expected timing. 3, impairment losses and reversals, if any, and where in the statement of comprehensive income they are recognized. Next, if applicable, the reportable segment in which the non-current assets or disposal group is presented in accordance with IFRS 8 operating segments. So those are the main disclosure requirements. Now friends, we come to the end of this session, and that is we come to the end of the summarized disclosures or summarized explanation of our first asset item, which was assets held for sale, and that's IFRS number 5. I wish you all the best in your revision on this area, and we'll want to do more and more. So our next session, friends, we'll be dealing with impairment of assets, IS 6. I hope you'll enjoy. Thank you. Have a nice time till we meet in the next session.